Last Friday was quite a difficult day. We started the day down, we got even worse. We got to the worst levels of the year and into official bear market territory, down 20% from the peak. And then all of a sudden, in the last hour, we saw a vicious-looking rally up to close to the flat line. That was an optimistic sign, but not conclusive. Just some sort of third time's a charm, trying to break the bear market level, not able to do that on a closing basis. What can happen next? Well, what happened next was a rally in the stock market, and a quite resilient rally in the stock market, because let's not forget, Joe Biden said, or made it sound like he was saying, and China reacted like he was saying, that the United States could very quickly and easily go to war with China over Taiwan. So we had a resilient stock market. NASDAQ futures at one point were up 1.6%. After Joe Biden said that, they were almost flat. And then they came, and NASDAQ's closing up a little over 1%. That, in my opinion, is quite bullish. We had that hit on the bear market territory, down 20%. It's a big chunk of all S&P 500 valuations. We had that rally on Friday, and then we had another strong rally on top of that. So now we've built ourselves some little tiny cushion, but a cushion nonetheless, above bear market levels. And that's not something to scoff at. And today, I think we're seeing the first signs of stabilization and a pause in the downward selling. If you look at what's winning today, it's actually not the ARC stuff. It's not the hardcore growth stuff that I happen to still like, at least some, and we'll talk about some position that's doing well that I don't have and I'm not going to buy, but is kind of emblematic of the rest of this stuff. We're seeing the more staple-based companies, the safer companies, the places the typical hedge fund managers are cool putting their capital to work, of which is at the highest level since 9/11, doing the best today. Look at the Dow. The Dow, obviously, just 30 big freaking names that are well-liked. It's up big today. So that's where they're going. They're going, and they're making their first buys, these hedge funds, it looks like to me. I am a little more confident. I have made my case, and I'll make it one more time again. The market had its initial correction based on the need for higher interest rates. The Fed was going to tighten, and that was the easiest trade in the book. We made that trade. We were in TBT, short the 20-year Treasury, up until just a couple weeks ago when we began taking it off and then took it off entirely. Now, actually, more than a month ago, on April 18th, Jim Bullard first said on CNBC that he says the market has priced in nearly everything the Fed's going to do based on their guidance, and now the Fed just has to follow through. However, since then, the market has lost, before today, over 11%, the steepest part of the most recent decline. It seems to me like that was not necessarily the rate adjustment, because yields were at 3% when Bullard said that. He also said the bond market was pricing in what the Fed was going to do, and we saw rates get a little higher after that, and now they had pulled back. So we've had this recession scare come up recently, and it was probably here the whole year since the beginning of January, but it's kind of amplified itself a little bit because inflation stayed pretty hot. But I'm not convinced on the recession. And Jamie Dimon isn't convinced on the recession, as he said today. I have been convinced on the recession. I've tweeted about this multiple times. I've been like, the onus is on the bears to show us where the recession is going to be, because yields are where they are, and there's no recession really yet. I get Q1, but strong dollar, exports, etc. Consumer balance sheets are strong. Target was down dramatically last week. The CEO could easily say, oh, this is outside of our control. Consumer is weakening. The Fed has to go easy. But no, he said there's no signs of consumer slowdown. And that seems to be echoed by the CEOs. It seems that the only people who think there's a recession coming are the financial commentators. And they're probably letting price of the market dictate their sentiment, which we're going to try not to do. And we didn't do when energy was being very volatile last year. We didn't do that when Omicron hit and I lost all my fees. We stayed based in the fundamentals. And the fundamentals, according to Bank of America CEO, is the consumer has a lot of cash on the balance sheet, and that should provide a pretty sizable cushion and hopefully some extra gas, as it may be the case that inflation is now peaking. I'm finally seeing sales at the grocery store anecdotally. We've seen inventory build up. Kathy Wood has talked about how this is going to be a deflationary force. Used car prices are rolling over. It seems like the last thing to roll over is energy, and I have no reason to believe energy is going to fall from here. But we're seeing demand destruction internationally in diesel prices. That's why diesel prices have actually come back. They got very high. They're still very high, but not as very, very high. Maybe we reach some sort of demand destruction in that. I don't know if it's going to happen. I have no way of saying that with certainty. But, oil trades in US dollars. The dollar is strong as hell right now, excuse my French. It's affecting, emerging markets. So I think there's a lot of negativity in the market. At least there has been. And that's pretty priced in. If you're afraid, of which is clearly the case, because as I said before, as is the title of this video, hedge funds have the most cash since 9/11. They've clearly sold positions to raise cash in anticipation of lower prices. It seems to me like those fears, there's some probability of them occurring, but it seems like we have overshot that probability of them occurring. And the area hated most by the market doesn't seem to be being brutalized that much. I mean, I'm not a fan of Zoom stock. I love the product, whatever, it's a good company, whatever. It's not it doesn't make its way into my portfolio. It just doesn't happen to. But they're still producing money. I mean, $3-4 of earnings per share, 20 PE ratio, that's not bad for one of Kathy Wood's top 10 holdings, which everyone just wants to dunk on. They are dunking on her. And I think it's ridiculous at this point. She's, just barely above March 2020 levels. But you know what she didn't do last Friday? She didn't hit her low for the year. That happened several days ago. So she's actually bounced. There's stocks in that growth space that I think are well priced, and I'm buying them. I have them. I'm sorry everyone else hates them, but I'm buying them. So, is what it is. That's today's video. We need this to continue. We need to see continued stabilization to really rule out any additional further downside and to say, okay, the selling has been exhausted, but it's looking good. It seems like people are starting to realize the fundamentals, or at least discuss them, and not just be a chorus of negativity. So we'll see what happens. That's today's video. And until next time, peace out.